Right now, 1 in 4 Americans with a student loan payment due is behind on it. Not struggling, behind. That's 7.9 million people who fell into delinquency in a single 15-month stretch. In Louisiana and Mississippi, it's not 1 in 4, it's nearly 1 in 2. Their credit scores didn't dip, they crashed by an average of 100 points in months. That's the difference between qualifying for a mortgage and being told no. And starting 4 days from now, a new federal law makes sure the next generation of borrowers has no way out of the exact same hole. Not a smaller hole, no hole at all, no floor underneath it. This is what comes after the crisis you've already heard about. Renata teaches middle school in Louisiana. She's 29, she makes $46,000 a year, she has $31,000 in federal loans from her education degree. She missed 4 payments last year, not because she stopped caring, but because her car needed a transmission and something had to lose. Her credit score dropped from 690 to 588 in 7 months. She applied for an apartment in March. She was denied, not for income, for credit. Renata is a legacy borrower. She still has access to the old safety nets technically, but she's about to take out one more small loan to finish a certification, and she has no idea that single decision will erase every protection she has left. That was a choice, not a coincidence. Here's the contract for the next 20 minutes. You're going to understand exactly how a debt crisis that already crashed 7.9 million credit scores got treated. Not as an emergency to fix, but as a business model to expand. We're covering 4 things. 1, how the delinquency crisis actually happened and who profits either way you land, paying or defaulting. 2, the new borrower rule buried in the law signed July 4th of last year, and the one small mistake that can retroactively strip a legacy borrower's protections overnight. 3, what happens to parents, to public service workers, and to anyone who loses a job after July 1st. 4, what this actually costs specific people starting this week. Let's get into it. Here's where the system stands today. Nearly 25% of borrowers with a payment due are delinquent, up from about 9% in 2019. That's a systemic collapse, not individual failure. It happened because pandemic-era payment pauses ended, and the Department of Education restarted credit bureau reporting for missed payments almost immediately, with no gradual on-ramp. 7.9 million people went from current to delinquent on their credit report in one reporting cycle. Here's the part almost nobody says out loud. The companies that service these loans, Navient, Mohela, Nelnet, get paid whether you pay your bill or not. They collect a servicing fee for managing the account regardless of outcome. Your default doesn't cost them anything. Your default is just a different line item on the same invoice. But this crisis didn't start with a missed payment. It started with a decision about who bears the risk when college gets more expensive than wages can follow. Go back to 1965, and the original Higher Education Act. The federal government stepped in to guarantee loans so more Americans could afford college. A genuinely good goal. But over the following decades, tuition rose roughly 8 times faster than wages because colleges knew federally guaranteed loans would absorb whatever price they set. The loan program didn't just help people afford college, it removed the one force that would have kept tuition in check. By 2020, total federal student debt topped $1.7 trillion. Pandemic-era protections paused payments for 3 years. The longest interest-free pause in the program's history. When that pause ended in late 2023, millions of borrowers had to restart payments on budgets that had reorganized around not having them. Wages hadn't caught up. Rent had gone up 20% in the same window. The math that worked in 2019 did not work in 2024. That's where the logic flipped. The system was never designed to ask whether a borrower could actually afford the restart. It was designed to restart the clock and let the credit bureau sort out the consequences. And then, in July of last year, Instead of fixing the mechanism that produced the crisis, the government signed a law that makes the exact same outcome permanent for everyone who borrows next. Not temporarily worse, permanently, structurally worse, with the safety nets removed before the next wave even shows up. That law is the One Big Beautiful Bill Act, and starting July 1st, it draws a hard line between two kinds of borrowers, and most people don't know which side of that line they're standing on. Here's why this crisis looks different from every other kind of debt trouble in America right now. The New York Fed tracks how much debt flows into serious delinquency every quarter. Mortgages, credit cards, auto loans, student loans, side by side. In the first quarter of this year, student loans had a serious delinquency rate of nearly 11%, more than triple the rate for credit cards, and nearly 4 times the rate for auto loans. Mortgage debt, by comparison, sat under 1.5%. Think about what that means. A mortgage is secured by a house. If you stop paying, the bank can take the house back, which gives lenders a reason to work with you before it gets there. A student loan is secured by nothing. There's no asset to repossess. There's just your credit score and your future paycheck. And in the same quarter, 2.6 million student loan borrowers who were more than 120 days past due got transferred to the Department of Education's Default Resolution Group, the office that handles wage garnishment and tax refund seizure. This isn't a debt category behaving like the others under stress. It's the one debt category in the American economy with no collateral, no easy renegotiation, and, as of 4 days from now, no deferment option for the people who take it on next. Here's the mechanism. The law creates 2 categories of borrower: legacy and new. A legacy borrower is anyone whose federal loans were fully disbursed before July 1st, 2026. They keep access to the old menu, standard, graduated, extended, and critically income-based repayment. A new borrower is anyone who takes out any federal loan on or after July 1st. They lose access to almost everything except 2 options: the Repayment Assistance Plan, with its 30-year forgiveness timeline, and a new tiered standard plan based on fixed payments, not income. Here's the part that turns this from a policy change into a trap. Imagine you're Renata, the teacher from Louisiana. You're a legacy borrower with every old protection intact. You take out one small federal loan in August to finish a $4,000 certification. That one new loan doesn't just get new borrower rules for itself. It converts every loan you already have, all $31,000 of it, into new borrower status, retroactively, permanently. You didn't sign anything that said, give up your old repayment plans. You signed for a $4,000 loan. The $31,000 came along for the ride. Now let's talk about parents. If you have a Parent Plus loan, there is exactly one way to keep access to income-driven repayment and public service loan forgiveness after July 1st. Your Parent Plus loan must already be consolidated into a direct consolidation loan, and that consolidation must have disbursed on or before June 30th, 2026, not applied for, disbursed. Miss that window, and you're limited to the tiered standard plan for the rest of the loan's life. No income-based payment, no PSLF, regardless of how long you've worked in public service. And here's the trap inside the trap. Even if you consolidated correctly and disbursed on time, taking out one more federal loan for any reason, a second child starting college, a new Parent Plus loan, reclassifies your entire consolidated balance under new borrower rules. The safety only holds as long as you never touch the system again. Now, the piece almost no coverage connects to the delinquency numbers you saw at the top of this video. For borrowers who take out any federal loan after July 1st, unemployment deferment and economic hardship deferment are eliminated, not reduced, gone. Forbearance, the temporary pause option that still exists, is capped at 9 months within any 24-month period, down from a 12-month annual limit and a 3-year lifetime cap under the old rules. Think about what that means next to the number from Block 1. 7.9 million people just went delinquent because they lost a job, or a hospital bill hit, or rent went up faster than pay. Those were legacy borrowers who still had deferment options available to them. Many didn't use them in time, or didn't know they existed, and that produced the crisis you're living through right now. The new law doesn't fix that failure. It removes the option that failure depended on for everyone who comes next. So walk through the full mechanism one more time, start to finish. A crisis happens because deferment options exist but aren't used effectively. 7.9 million people fall behind. Credit scores crash by an average of 100 points. The response to that crisis is a law that removes the deferment options entirely for the next wave of borrowers. That same law creates a rule where touching the new system even once, one loan, one consolidation, one parent plus renewal, permanently reclassifies every dollar you've ever borrowed. And the alternative to federal borrowing under the new tighter caps is private lending, SoFi, Sallie Mae, Earnest, loans with no income-driven repayment, no forgiveness, and no deferment options at all, at rates 2 to 3 points higher than federal loans. The system didn't get safer after the crisis. It got a permanent one-way door. Let's put a real number on private lenders at higher rates, because right now that phrase is doing a lot of work without much math behind it. Federal unsubsidized loans for the 2026 to 2027 school year carry a fixed rate of 6.52%. Private lenders, SoFi, Sallie Mae, Earnest, College Ave, advertise rates as low as 2.39%. But that headline number is reserved for borrowers with excellent credit, a cosigner, and autopay enrolled. For a typical graduate student or a parent without a long credit history, real private rates run closer to 9% to 14%, and the ceiling on many products sits near 18%. Run that through an actual loan. Take Elena's $21,500 funding gap from her third year of law school. At a federal rate of 6.52% on a standard 10-year term, that's a monthly payment of roughly $244. At a private rate of 11%, a realistic number for a law student without an established credit file, that same $21,500 costs $296 a month. Over 10 years, that's an extra $6,240 for the exact same money, borrowed for the exact same degree. And private loans don't offer income-driven payments if her income drops after graduation. They don't offer forgiveness after 20 or 30 years. Most don't offer deferment if she loses a job. If she can't pay, there's no RAP, no IBR, no safety net conversation with a federal servicer. There's a private collections process, and a lawsuit, and a judgment. The federal caps didn't make her degree cheaper. They just moved the last $21,500 of it into a part of the lending market with none of the guardrails the first $20,500 still has. Here's what the press release left out. The Department of Education's own framing calls this protecting taxpayers from unsustainable loan forgiveness. That's the sales pitch. Here's the actual mechanism underneath it. The 7.9 million delinquencies weren't caused by borrowers gaming the system for forgiveness. They were caused by wages that never caught up to tuition and a repayment restart with no functional on-ramp. The law's response treats every future borrower as if they're the reason the system is strained, while doing nothing to address why 40% of borrowers in Louisiana and Mississippi are already behind. And here's the sentence that should stop you. The contamination rule, one new loan converts your entire existing balance to new borrower status, was not required to fix anything. There is no fiscal argument for why a legacy borrower's old loans need to lose their protections just because that borrower took out one new, unrelated loan. The only function that rule serves is making the safety net feel unsafe enough that people avoid touching federal loans at all, which pushes them toward private lenders instead. Here's who benefits. Not one company with a household name. Something more structural. Federal loan servicers get paid per active account, regardless of whether that account is current, delinquent, or in default. A borrower stuck on a 30-year repayment assistance plan generates 30 years of servicing revenue instead of 20. That's not a side effect, that's the product. And every dollar pushed out of federal borrowing because of the new caps and the contamination risk becomes a dollar flowing to private lenders. Sallie Mae, Ernest, at higher rates with none of the protections that federal loans still technically offer. The crisis you saw in Block 1 wasn't an argument for more protection, it became the justification for removing it, for the exact population most likely to need it next. Here's how that credit damage actually travels outward into the rest of someone's financial life. A 100-point credit score drop doesn't just feel bad, it has a price tag. A borrower with a 720 credit score qualifies for a mortgage rate roughly a full percentage point lower than a borrower at 620. On a $300,000 mortgage, that 1-point difference is worth over $60,000 in extra interest across 30 years. A crashed credit score from a missed student loan payment doesn't stay contained to student loans. It follows you into every car loan, every apartment application, every mortgage rate quote for the next 7 years, which is how long a delinquency stays on a credit report. Renata, the teacher from Block 1, found this out applying for an apartment. Somebody else finds it out at a car dealership, financed at 14% instead of 7% because of a $200 payment they missed 2 years ago on a loan that had nothing to do with the car. The student loan system was never designed to only punish you inside the student loan system. It was designed to report to the 3 bureaus that decide almost everything else you try to finance for the rest of your adult life. Remember the number from the top. 7.9 million people already delinquent, credit scores down 100 points on average. Here's exactly what the next chapter of that looks like for real people. Renata, the teacher in Louisiana. If she takes that $4,000 certification loan in August, her entire $31,000 balance loses access to income-based repayment forever. Her only options become RAP's 30-year timeline or a fixed payment she can't adjust if she loses hours again. One signature, total reclassification. Tomas is a Parent Plus borrower in Phoenix. He consolidated in May, dispersed June 12th. He made the window, but his younger daughter starts college in 2 years, and he'll need a second Parent Plus loan to cover it. The moment he signs that second loan, his already consolidated balance, the one he protected correctly, gets pulled into new borrower rules too. Priya is a public defender in Cleveland, 4 years into public service loan forgiveness. She's a legacy borrower, protected, for now, but if her office's loan repayment assistance program requires her to take a new federal loan to cover a bar certification renewal, she loses PSLF eligibility on every dollar she's already paid toward it. 6 years of qualifying payments reset to a program that no longer applies to her. And Marcus, not the Marcus from 6 weeks ago, a different one, is a warehouse associate in Shreveport who was laid off in April. He hasn't borrowed since 2019, so he's a legacy borrower with deferment options still available today. But he's considering a federal loan next year to finish a certificate that could get him a raise. If he takes it and loses a job again after that, he will have no deferment option left at all, no matter how long he's out of work. And Jasmine is a first-generation college graduate in Jackson, Mississippi, one of the 2 states where nearly half of borrowers with a payment due are delinquent right now. She graduated in 2022 with $28,000 in federal loans and a job offer that fell through before she started making payments. She's been delinquent for 11 months. Her credit score dropped from 650 to 561. She's a legacy borrower, which means she still qualifies for income-based repayment today. A plan that could set her payment near zero based on her current income. Nobody at her servicer told her that option existed while she was falling behind. She found out about it researching for a completely different reason 3 weeks ago. She's applying this month before July 1st, so she never has to touch the new system at all. If she'd found out in October instead of June, None of that would matter. She'd already be applying under RAP's 30-year clock on a system that never explained the exit that used to be available to her the entire time she was drowning in it. Strip the press release, and the ledger reads like this. The student loan crisis didn't happen because borrowers stopped paying attention. It happened because wages never caught up to the price of a degree the system had every incentive to keep inflating. 7.9 million people fell into delinquency, and their credit scores paid the price a bank never has to pay. The response to that crisis wasn't to fix the gap between wages and tuition. It was to write a law that makes the safety net conditional on never touching the system again. One loan, one signature, and every protection you had disappears retroactively. That is not an accident of drafting. That is the design. The servicers get paid whether you succeed or fail. The private lenders get a new market every time the federal door narrows. And the borrower, the only party in this entire system who took on real risk for a real education, is the only one who was never protected from the outcome. The next 7 million are already on the clock. Most of them don't know it yet. If this is the first video you've landed on, this is what we do here. The story underneath the story. Subscribe to American Ledger Journal. Hit the bell so the next one finds you. And if this gave you something worth passing on, send it to someone who needs it.